morning. You're watching BloombergQuint. It's been two blowout quarters for Laurus Labs, with the second quarter bringing in 60% year-on-year growth in revenue, a continued surge in EBITDA margin to 33%, and a 325% increase in profit. CapEx plans are aggressive too, with 50% to 80% new capacity plan in both the API and formulations businesses, which are the two core businesses of this company. And just yesterday, Laurus closed a 250 crore rupee deal to acquire Richcore Life Sciences. This acquisition will give Laurus Labs entry into the biotech space. So to talk about all of this, on Talking Point this morning, I'm joined by the founder of Laurus Labs, Satyanarayana Chava. Dr. Chava, thank you very much for joining us this morning. And let me just get started by asking you to lay out all you can on this biotech acquisition. It's a small acquisition in terms of 250 crores, as I understand the acquisition price, but it adds a fourth revenue stream to your business, and I'm hoping you will tell us about the potential.
Thank you. Good morning. If you look at our strategy from the beginning, is to identify one area, start putting resources into development, create large-scale manufacturing, and then grow that business and identify new growth levers for us. First, we did in APIs, and we did focus in custom synthesis. And in 2014-15, we did focus on formulations. That's where we set up a large-scale facility for formulations. From no revenues in 2016-17, we crossed almost 800-900 crore revenue in the first half, and then going to do very well in this division. When we have three revenue streams, APIs, formulations, and custom synthesis, we were looking for what could be our next growth driver. And we thought the next growth driver will be biotechnology. And if you look at our gestation period for us to do greenfield biotechnology, build team, build capacity, develop products, it is a 6 to 7 year gestation period. Our idea is to cut down this gestation period significantly by doing an acquisition, which is like a startup. So we identified Richcore as all the qualities what we're looking for our foray into biotechnology. And we did close the deal yesterday for majority acquisition. Interestingly, what we acquired, the stake is only from private equity partners, 8 Roads and Venturist. The current founders and promoters, the senior management will continue to drive that, and we will only help them to grow faster.
Okay, Dr. Chava, can you talk us through specifically what opportunities in the biotech space this acquisition gives you? And what is the potential market size of this? And as you would have planned this acquisition, you would have sort of tried to also project what it might add to your revenue streams over the course of the next 1 to 3 years.
Currently, Richcore makes animal origin-free ingredients for cell culture. Their unique proposition is what they make is animal origin-free. That's their unique selling point. What they make currently is cell culture ingredients. They make enzymes for health and nutrition. And they just started doing proteins, contract manufacturing, from their R&D and launch scale facility. They started building large scale facility, and which we expect it will be ready between February and March next year. That's where the quantum jump in revenues will come. And not only that, we will help them to put up even more big facilities to capture contract manufacturing opportunities in recombinant protein space.
Dr. Chava, what is the size of the business right now in terms of the revenue at Richcore? And what do you hope you might be able to increase it to in the next year or 2 or 3?
We are not giving any guidance even for our Laurus Labs, so it is not fair on our part to give guidance there.
Okay,
but
the current revenue size for...
The first 6 months, they have done about 30 crores, and we expect they will do better than the first 6 months in the second half. And the major flip will come once their large-scale facility come on stream, which will be March 2021. And what the integration benefits of Laurus Labs are in the space of biocatalysis, or in the place of fermentation of some steroidal intermediates where we are very strong. So we will utilize their expertise in enzymes design and manufacturing, while we help them to build large-scale facility to produce ingredients, to produce enzymes for health and nutrition, enzymes for industrial use, and also the big opportunity where we are focusing, as I mentioned, doing contract development manufacturing of recombinant proteins. That's where we expect they will generate significant revenue in the medium to long term, and where we are willing to help them to put up a large capex there.
Okay, so your significant revenue opportunity in a business like this, you're saying, comes from being able to invest in additional large capacity and therefore being able to grow the business. That's where you see the big boost coming in the, let's say, next 2 to 5 years, even if you won't give us any numbers. Is that correct?
The major revenue boost will come from the new facility, which will come on live March next year.
Okay.
And that will be very significant growth for them. And the next growth driver will be they have to set up one more facility for which they already acquired land. And that will come on stream by end of next year. So they have to continuously invest to grow their business. And we don't expect to invest any further equity into the company. Whatever cash they generate internally and partly through debt, they can meet their capital obligations.
So how much is their capacity now, and how much does it increase by thanks to these capacity additions over the course of the next year or two? Can you give us some numbers on that?
Currently, they have about 17,000 liters fermentation capacity from their kilo lab, launch plant, whereas they are building a 180,000 liters fermentation capacity in the next one building. And then they already acquired land to build one more plant. That plant will be double that of the plant which will come live in March 2021.
So we're talking about 250,000 liters capacity by the end of what? April 2021, and then another plant of the same size in the year after that. Is that correct?
You're right. You're right.
Okay. Just a quick last question on ownership. You don't own all of this company. The current promoters of Richcore are staying on, right? So, I mean, what's the management situation, or how does it work? They continue to run the business, and this will be a subsidiary of Laurus Labs?
Yes, we are acquiring a little more than 72% of the equity, and the rest is held by the current founders and promoters. They continue to run the operations, and we will only help them to grow. So that is very important here. So the technocrats, the team who built Richcore so far, will realize their dreams by joining with us. So we'll help them to scale up. We'll help them to grow.
So what do you bring to the business, sir? Because you said there are some small synergies. If I was just to contrast this with the way you built out your formulations business, your formulations business was built on the back of immense synergy between API and formulations, right? Because the bulk of your formulations business is also in ARV, which is antiretroviral business. But in this case, this is a completely different market. And whilst there's some synergy in some of the products that you have, it's not necessarily going to be the same kind of leverage that you can put in, right?
A very interesting question you have put. So you are absolutely right. Our formulation strategy is based on backward integration into APIs. Similar thing we wanted to do in Richcore. Why this is possible? They make ingredients, they make enzymes, and they know how to make recombinant proteins. So that will become a fully integrated biotech company. Like what we have done, fully integrated pharmaceutical company. Richcore has all ingredients to become a fully integrated biotech company. So we wanted to get there. We don't have capabilities earlier. With this acquisition, we believe we will have capabilities in the form of Richcore to realize our dreams as well. To create a,
Yeah. No, Dr. Chava, forgive me. I'm a layperson, so I don't necessarily understand where the medical synergies lie, where the pharmacological synergies lie. There is nothing from this biotech business, which of course in itself might have great growth opportunity, that actually lends any synergy to your current API or formulations business or custom synthesis business. Have I understood that correctly?
It will not help anything into our formulation business, as you mentioned, but it will have synergies in our chemical business. We can make our processes more clean, more green by utilizing biocatalysis, where Richcore has tremendous experience. And we can also do fermentation of some of the steroidal backbones using their expertise. So there are synergies, but these synergies will help Laurus Labs. These synergies will not help Richcore to grow. So we'll help them to grow in their core business, which is going to be recombinant proteins, while they continue to help the parent company by redesigning enzymes for our biocatalysis and also helping us to set up fermentation facilities to do backward integrating of steroids.
So this is a completely new growth area. It has very little to do, marginal assistance, as you pointed out, but very little to do with being able to add any leverage to your existing API or formulations or custom synthesis business. Marginal improvements in your existing businesses, but it's a completely new growth area, right?
You're absolutely right.
Okay, so let's go back now. Is there anything else I might have missed about this acquisition that you might want to share with investors, since we have this?
No, it's very good. I think you nailed it on very well. What synergies and how this will become a new growth driver for us is very well articulated.
And you also pointed out, sir, that you're not intending to invest any more money, at least in the next year or two, in this business. Pretty much all of the investment will be done by Richcore itself on its balance sheet, either through accruals or any additional debt that they may need.
Absolutely. Okay,
fine. So your expense is now limited to about 250 crores, and therefore your benefit is also limited to that 72% ownership that you have of the company.
Yes.
Is there any plan at this point in time to want to merge that with Laurus Labs or make it 100% subsidiary, or is it too early to tell?
It's too early to talk about that.
Yeah. Okay, but your investors in Laurus Labs will only actually fully benefit. Because right now it will just be an income contribution. They will only actually fully benefit when you're able to bring both businesses together, right?
This will be majority owned subsidiary for us. We are not owning 51. We will own more than 70%. Yeah. So it's a majority owned entity. Yeah. So that will immensely benefit the current shareholders of Laurus Labs, I'm sure.
All right. Okay, fine. Let me go back to now what, if I may call it, your traditional businesses. In that sense, you've had a blowout 2 quarters, as everybody has pointed out. I think I want to start with talking about the formulations business and how you've built that over the last 3-4 years. It's gone from 160 crores to about 452 crores in the second quarter. It's now almost the size of your generic API business. How do you sustain the kind of growth you've seen in the formulations business? Because I heard you say in your analyst call that there is no one-off that has helped this kind of robust increase in the first half of this year in your formulations business. The growth has been led by, and I quote you saying, increased volumes of our existing products from existing customers. So you only were able to gain market share in this business. And what is the next lever of growth then for the formulations business?
As you mentioned in our Q1, Q2, we didn't have any one-off profits. So these are backed up by our investments, what we did in the previous years. And we were able to ramp up our API capacity to support our API growth and also to supply APIs to our formulation division.
Right.
And interestingly, our growth in formulation business will come from our investments into capacity expansion, which will be ready by end of this year by debottlenecking. New capacity will come by April partly, by June in the phase 2 of our expansion. So we are having capacity enhancements in phased manner starting from end of this year to end of next year. So that will double our capacity, what we have right now in formulations. And we are getting approvals on a regular basis. So our growth in formulations is already well cemented by way of ANDA filings, by way of building capacity. As and when we get approval, we're able to launch, we're able to increase our market share. So our growth in our formulation division, we believe, is very, very well within our reach. And interestingly, what is also happening, the growth in our API revenue is also significant than what we anticipated. And as you mentioned, our formulation business is equivalent to our API business. But interestingly, our API business will be much bigger this year than our formulation business while we continue to grow our formulations. So we have still a lot of steam left to grow in our API business because we're adding more non-ARV APIs to our portfolio and a lot of non-ARV portfolio to formulations also. What is also very significant to note, our custom synthesis business is also growing very well. And
Sure.
that's where our gross margin levels are very high. And
Yes.
that is lifting the gross margins for the rest of the company well. So we expect to at least maintain our gross margin and EBITDA percentage in the coming quarters. So we believe our Q3, Q4 will be better than what we have demonstrated Q1, Q2.
Okay, I'll stay with the formulations business for a bit because I think in the last quarter you did about 183% year-on-year increase in revenue in the formulations business. Now I understand, sir, that I think the business is 75% of what you sell is the ARV tender business to low middle income countries, and about 25% is generic products and contract manufacturing for developed countries. As you add this capacity, and I'll come to a broader question on capacity expansion, but as you add this capacity, where are you hoping to be able to sell more? Is it the tender business that has more potential in low middle income countries, or is it the generic products business in the developed countries that you believe will be able to absorb this new capacity?
Debottlenecking of existing capacity will be utilized to ramp up our ARV formulations, while the new capacity, which will come up in phased manner from June next year onwards, will be utilized for non-ARV formulations. So the significant revenue growth from maybe FY23 onwards in formulations will come from non-ARV. And similarly, in FY23 onwards, our major growth in APIs also will come from non-ARV. So, because ARV, we have a limited portfolio, and we have done all those APIs already validated. And same thing is going to happen in formulations. We are going to finish all the filings and approval for ARVs, if not this year, in FY22. So FY23, not much of portfolio is left to develop in ARV APIs or formulations. So the growth will come from non-ARV in APIs, non-ARVs in formulation. So if you clearly understand, the growth or gross margins in non-ARV business is much higher than ARV. So it is very easy to expect as we grow in these two segments, our definitely profitability will be better than what we have demonstrated right now.
Your margins may improve, sir, as your shift goes from 75-25 to 50-50, or however your, depending on your capacity expansions coming online. But I'm also curious, what about the stability of orders? Because your ARV business is very tender driven right now, from what I understand. Whereas your generic products or non-ARV business might not be as much. Is the competitive landscape, a lot more difficult in that space, and therefore stability of order book, will that change as this mix changes?
When it comes to API, majority of our API goes into non-integrated players in ARV formulations, where we service, say, 6 out of 8 customers. Today, A will get order, tomorrow B will get order, tomorrow C will get order. But orders will come to all these players. So our API sale is very, very sustainable there. When it comes to formulations, although people call this as a tender-driven business, we have orders for supplies in next June. So these orders are not placed for next month's supply. These orders are placed at least 3 to 6 months in advance for supplies. So there is a reasonable visibility in the order book for formulations as well. So we see this is a very stable business. And in the tender, majority of the tenders, winner doesn't take all. So whatever the low price people give, they might get more than 35% of the share. So that's why this business is very, very sustainable.
Can you explain that pricing point again to me? Because from what I can understand, your stellar growth in these first 2 quarters has come mostly from being able to acquire market share in both your API and formulations business. If I remember from your analyst call, etc., you said pricing has not had a big play in this.
You are absolutely right. We haven't decreased prices. At the same time, we haven't increased prices. We're able to maintain stable pricing for both our APIs as well as formulations. As I mentioned in tender business, they give orders to first 3-4 companies in the order of say low prices. That means even somebody gives a low price doesn't mean he will win 100% of the tender. He will win 30-40% of the tender. So the tender award is reasonably distributed to 3-4 players. So that's where the chances of winning the tenders is very likely for integrated players like us.
Okay, sorry. What I was trying to understand is, because I know this has been a planned shift in the revenue mix for you, right? Both in the API business and in the formulations business. I think in FY16, about 82% of your revenue was mostly ARV API, which is antiretroviral API. Now that portion is down to about 34%, which is about a third of your business is ARV API in this year, and generic FDF, which is your fixed dosage formulation or your formulations business, is about another third. You expect this mix to change even further. You've just told me that in the formulations business, a lot more of your focus will be in the non-ARV part, the developed country orders, the generic product orders. So as you sort of continue to change this revenue mix, you're saying that your margin profile will not be impacted in any way, and your stability of orders will also not be impacted in any way.
See, the shift in ARV APIs to fully integrated formulation pharmaceutical companies is very visible, and we do expect the shift will come in ARV formulations versus non-ARV formulations. Right now, from 75-25, in the next 3 years, it will be 50-50 in formulations. When it comes to API, ARV APIs, we do expect it will remain around 30% in the next 2 years to come. But still, there is some growth we expect in ARV APIs because we haven't got much inroads into second line ARV APIs. So we expect that will happen in the next financial year. So we expect ARV APIs will contribute in the medium term about 30% of revenue, and non-ARV APIs contribute maybe 20% of revenue, and about 30-35% revenue come from formulations, and about low teens percentage will come from our custom synthesis business. I think while our revenue base will grow significantly, but we do believe these ratios will maintain at least in the next 2 years.
Okay, and so in effect, what you're saying is that when we try to understand how your margin profile changes or your order book stability changes, there will be no change in either one of these. You will just keep growing your business by acquiring more market share in both of these businesses.
You're absolutely right.
Okay. In this particular quarter, that's the second quarter, you saw 43% growth in your oncology API business. Is that a one-off by any chance? I mean, what explains a 43% growth in one quarter?
We always growing our oncology business by 20-25% in the last several quarters. And we do believe we will continue to grow in our oncology business because we have the largest capacity of oncology APIs in the country. So it is very obvious to expect leaders will grab more market share from the weakest players. So that what is happening, we have to launch many new drugs in oncology, but we were able to gain market share. So market share is shifting in this crisis from the weak players to strong players. We had significant launches, old molecule launches by our partners, and they gained market share and we gained market share.
And this market share is not price sensitive. So, I mean, what are the chances that you might lose some of this market share if you don't stay price competitive? Or will you have to discount pricing at some point to be able to hold on to this market share?
Oncology API space is very insulated by price fluctuations. We haven't seen people negotiating prices because the API price in oncology formulations is not that significant like ARVs. ARV API prices contribute 70% of sales, whereas in oncology it contributes very small portion of their sales. So they need a stable, sustainable player who will deliver oncology APIs when they need, and at the right quality at the right time. So we don't expect margin pressure on oncology APIs while we continue to grow.
So your ability to hold on to this market share, whether it's an oncology API or what you've been able to increase in your formulations business, all of this is predicated only in being able to add further capacity, for which you seem to have outlined about 1,200 crores in capex plans for the next financial year. Is that right?
Yes, you're right. Yeah.
So it's just about building more capacities to supply the market. And you think that all of those capacities will be easily absorbed because you will be able to hold on to this kind of market share.
The market share we are gaining, especially in ARV, not from our competitors. We are gaining market share from the new patients who are introduced into the treatment. For example, every year between 1.5 to 2 million new patients are added into the treatment. So that pool is significant. So each million patients is about $70-80 million in revenues. 2 million patients means $150 million new business is coming. So that business is significant. So it's very easy to understand we are grabbing the new market, what is introduced, rather than snatching market share from somebody else.
That's in the ARV API business. Does that apply to the ARV formulations business as well as a corollary?
I'm talking about ARV formulation business. In the ARV API business, people are buying more APIs because of a switch from one therapy to another therapy, from one regimen to another regimen, where our partners had approvals of all APIs in the 3 combination drugs. So they were buying 3 APIs from us. Earlier, they used to buy 1 API. So we are selling more quantity of 3 drugs, which will go into one formulation. Whereas when it's come to oncology, our partners gain market share and we gain market share. We haven't launched any new drugs in the last 2 quarters.
Okay, so it's a little complex. I'm trying to wrap my head around this, so you'll forgive my ignorance for it. But in the bulk of your business, which is the ARV formulations business, as well as the API business, most of your market share is coming from new patients being added to that segment. Whereas, let's say in the non-ARV businesses, both in formulations and API, your market share is coming from being able to take away share from competitors.
Yes.
Is that too much of a simplification? Sorry, I'm just trying to figure out
it's easy way to put it. Yes, we are gaining market share in APIs from our competitors. In the formulations, we are getting market share by serving new patients. That is very easy to put. Okay. You're right.
You've discussed your 1,200 crore capex plan in detail, both in your earnings as well as your analyst call. So I won't spend more time here discussing that. What I do want to understand is whether any of this spectacular growth that you've seen in the last couple of quarters, or even in previous quarters, because your growth trajectory has been very steep, how much of this has to do with the anti-China effect? That, in the world, people are moving away supply chains from being entirely China dependent. Do you see that playing a big role in the way you're receiving orders?
If you look at majority of revenues coming from DMF based or ANDA based, to change an API in an ANDA in this business, it takes 18 to 24 months. If the shift is happening in the last 9 months, and we haven't seen any of that shift in our API business or generic formulation business. But that shift we have seen in our custom synthesis business, we're getting more starting materials, intermediates, as part of our partners' dual sourcing strategy rather than one vendor. So we have seen that traction positive in our custom synthesis business. But for us to see the traction in our API and formulation business, we have to see maybe another 9 to 12 months to see any positive traction. So our growth in API and formulations has nothing to do with these sentiments.
Okay, but you've got a ear to the ground. So this move away from China-dominated supply chains, you're saying will show some benefit to you in your business in another 9 to 12 months, is it?
Yes, possible. Yeah.
Okay. One more question on the CapEx plan, and that is, are you going to be participating in the government's PLI scheme? Because I know that they're, hoping to be able to offer incentives in a few select sectors to be able to ramp up manufacturing in the country. You're already ramping up manufacturing, but will you be participating in the PLI scheme? Any thoughts on that?
PLA scheme, in my opinion, is a good step in the right direction, but the road is very long.
Okay.
So it will take very long time for people to realize or become self-reliant. These knee-jerk reactions will not make any company or country self-reliant. We need long-term planning, and we have a couple of products we're evaluating to submit, but that is not going to be a significant portion of our growth anyway. So whether we win any product in the PLA scheme or we don't win anything, is not going to be significant. But we have some products where we would like to participate.
Okay, so one last theme that I want to talk to you about. You've said very confidently in your earnings and your analyst calls that Q3 and Q4 are going to be even better. In our conversation this morning, you've suggested that this growth trajectory is going to be almost as steep, with the exception of base effect, for maybe even another year or two, and then you're hoping that the biotech growth will kick in. What are the risk factors here that investors, stakeholders should be aware of? Things that might derail some of your growth plans.
See, our growth is, if you look at any pharmaceutical company, the product introduction has to start 3 to 4 years before those are actually launched into the market. So our growth in, say, FY21 is not based on what we are doing in FY20 or FY21. So our growth in FY22 is already cemented by creating capacities, by developing products, by filing products, getting approval. So the risk is, our facilities were inspected very recently and approved by various regulatory authorities. And our growth is not coming from new product launches. Our growth is not coming from new facility creation. This will coming from an existing capacity or capacity being created on the existing sites. So we see little risk, but no business is insulated from any risk. But we do see we can manage any little risk. For example, during this COVID, there was a crisis to source raw materials, and we incurred significant freight costs, and we were able to bear, and we didn't pass it on to the customer. So we were able to run our factories at optimum level during the COVID crisis. So it costed us in the first 6 months additional 30 crores for way of incentivizing by buying protective gear and donations, CSR, all those. So we will have the ability to withstand shocks. And our growth, we believe, we are very comfortable. Otherwise, we never gave any guidance so far. So we are giving some soft guidance because we have confidence on what we will do in the near future.
That is top line growth, sir. You've also had a spectacular rise in margins. It's a little mind-boggling to see that kind of increase in a series of a couple of quarters, where you see profit margins or EBITDA margins move up to that extent. Now, there is some view amongst analysts that, the best of the operating leverage benefits in your business between API and formulations has now fully been captured for Laurus Labs. You've also mentioned, both in your analyst call and the conversation we've had this morning, that pricing is not what led to margins, it's operational efficiencies. How much more juice is left in that?
As we grow revenues from oncology, revenues from custom synthesis, I think our margin improvement is still possible if we grow in those divisions.
But your mix will stay the same, right? You've just told me that your broad revenue mix of one third, and then some of your other businesses, that's not going to change. So your custom synthesis business will grow in size, but proportionately will stay the same. So it's not going to have any disproportionate contribution to your margin profile.
See, we are not adding new sites. We are not adding any new R&D expenditure. So we still have a lot of room we may not improve our gross margins, but we may improve our profits percentage, whether PBT, EBITDA, or PAT, because our rest of the expenditure is not increasing on par with our gross margins.
All right. Okay. We'll leave it there, sir. Thank you so much for joining us this morning, talking us through your new stream of business, which is biotech, and the growth profile for your existing businesses. Dr. Chava, thank you very much this morning for speaking to Bloomberg.
Thank you for your interesting questions. Thank you.
Thank you.
Thank you. Thank you.